Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, January 5th, 2019. Happy New Year. And in lieu of the fact that we don't have a lot of major information coming out in the markets in the last week, I wanted to touch on a subject which I believe will be affecting the markets over the next several years, and which I think could be and has a high probability of being the next catalyst for the next financial crisis, and that's the corporate bond market. So in the last 10 years or so, or 15 years, whatever, especially since the last global financial crisis, we've seen a tremendous amount of new debt creation around the world at all levels, government, financial, corporate, and individual. And currently, worldwide debt is approximately $237 trillion. It's a new record. And that's on top of a world economy of about $84 trillion a year to support that debt. So we're running a debt to GDP ratio, if you will, of 3 times. So I think going forward, the various levels of debt that we have at all different levels of society are going to be a problem, especially if we're going to be in a higher interest rate environment. But today I want to specifically talk about the corporate bond market. And I think the first thing we have to do is have a review of what a bond is. I think I make the mistake sometimes in a lot of these videos, and I've been told this by some of the listeners. I kind of talk above people's heads sometimes, so I want to do a basic review of what a bond is. People need to understand what we're talking about around corporate debt. So I got this definition and these terms from Investopdeia. It's like a Wikipedia for investment. I'll put a link to it, and specifically to the section on bonds, so that listeners that are curious can go and do some more research to get a full understanding of what we're talking about here. So basically, a bond is a fixed income instrument that represents a loan made by an investor to a borrower. Typically, you're loaning money to a government or a corporation when you're buying a bond. A bond can be thought of as an IOU. Okay, so prices when the bonds are issued are set at what's called par, and par is $100 or more typically $1,000 denomination. So say the United States government was going to issue a 10-year or a 30-year bond at 5%. The day of issuance it would be $1,000, and in 30 years you would get your principal back, but you'd be paid 5% annually on that. You'd be given $50, an annual payment of $50, and then given your full $1,000 back at the end of the term. So the actual market price of bonds depends on a number of factors. The credit quality of the issuer, the length of time until expiration of the bond. In our example, we use 30 years. And the coupon rate compared to the general interest rate environment at the time. What they're talking about coupon rate is, in our example, let's say that we said it was a 5% bond. That's the coupon rate, 5%. And they call it coupons because back in the old days, everything's done electronically now, but back in the old days, you were actually issued a bond, and it had coupons on there that you would clip off, send in, and get paid or take down to the company or to the bank, and they would pay you. That's why it's called coupon rate or clipping coupons. That's what that refers to. I'll get into why bond prices change a little later in the video, but the fluctuation in interest rates can also affect the market price of the bonds, because these bonds do trade in the market after they're issued. There is a market for them, just like there is in the stock market. And of course, like we mentioned before, the face value of the bond is what will be paid back to the borrower once the bond matures. So if it's a $1,000 bond and the term is 30 years, you will get your 5% interest every year, and you will be paid back $1,000 in 30 years. So what affects bond pricing? Like we said, interest rates are the main thing. And why is that? There's a pretty good explanation on the Investopdeia site, but quickly, For example, in our bond that we're using, a 5% bond that has 30-year duration, if rates, like I said, it's a fixed rate, so you're at 5% every year. So if rates were to go up to say 6 or 7%, people are going to probably want the higher return. So in order for the 5% bond to reflect the fact that interest rates are higher, the price of the bond would have to decrease such that the effective yield would then be 6%. So the price of the bond would no longer be $1,000. It would probably drop to like $950, $940, whatever, to reflect the fact and compensate a new buyer for the fact that rates are actually higher. Because if you can go buy a bond that pays 6%, why would you buy a bond that pays 5% for the same price? It's stupid. So the market arbitrages those differences in rates in the price of the bond. I hope that's not too hard to understand. Same thing happens if interest rates go down. If you have a 5% bond and interest rates drop to 4%, then the price of your bond will rise to reflect the fact that it's paying more than all the other bonds that are being issued at a lower rate. So that's hard for a lot of people to understand, and I think that's going to result in a lot of people getting smoked. There's a lot of investors out there that have no clue that bond prices fluctuate. They think, I bought this bond ETF, and when this crisis happens, or if rates go up, the price of the ETF goes down to reflect the fact that their bonds that they're holding with lower rates are worth less. And that shocks a lot of people, and they don't understand that. So it's very important to understand that interest rates are the main factor that affects the pricing of bonds after they're issued. Now, with respect to corporate bonds, credit quality of the company matters. If their companies are giving ratings on their debt by various credit agencies like Moody's, S&P, Fitch. These are rating agencies that deep dive the financials and give a rating to these bonds such that you can look at it and not, if you want to have higher credit quality, it's like AAA, AA, A, all the way down, B, double B, triple B, all that. So you can look that up. The different agencies have different methodologies they use, but credit quality of the company as attributed to it by a rating agency has a lot to do with the quality of a bond or the pricing of a bond also. So credit availability. If we're in a credit crisis or a recession or depression like 2008 when we had the financial crisis, credit tightens. Nobody wants to loan money, so it gets harder and harder to sell these bonds, and liquidity dries up. So you can have drops in prices of bonds because no one will buy them at the current price. They have to be discounted severely for somebody to buy them. That kind of segues into the overall credit conditions as dictated by the quality of the economy at the certain point in time. If the economy is going great guns and everybody's making money, it's very easy for companies to service their debt, and it's not really a problem. Everything the machine seems to work. It's all greased up, all the gears are meshing, no problem. Conversely, if the economy is bad, then things get very difficult for companies to service debt. The credit quality and the agencies start downgrading debt, and that makes things more difficult for the companies to service or refinance. And that consequently means that the bond pricing gets weaker. Obviously, individual business conditions, the ability to service debt. One of the biggest bankruptcies in the last year or two was Toys R Us. They went bankrupt. Bondholders got wiped out. That was a reflection of the fact that, the big box store business model is being disrupted by online sales, specifically Amazon. Toys R Us sales went down. Their ability to service their debt went down. They defaulted. Company goes bankrupt. Bonds are worthless. That's what happens. Okay, so that's kind of a quick introduction. Like I said, I will put some more links into the video notes so that people can do some more education on their own. If you have questions, put them in the comments. We'll answer them. and we'll get you up to speed because you need to understand this to take advantage of the opportunity that I think is coming down the pipeline. So why is there a bubble in corporate debt? Well, after the 2008 great financial crisis, or the global financial crisis, the world's central banks slashed interest rates to zero, and in fact into negative rates. There was talk of these are the lowest rates in 5,000 years. We heard stuff like that when rates were actually negative, and these banks were paying people to actually buy the debt. You were actually being paid. When a negative rate, you're being paid to buy and hold the debt. What this did is it preempted the necessary cleansing of the system. So over time, different businesses that shouldn't exist or are not effective anymore or are being supplemented by new businesses, there's a natural cleansing of the market that should go on, where new businesses come along, old businesses die off, and we go through these restructurings, whatever. It's the invisible hand at work. But when we had the crisis, because these things are very politicized, because there's massive unemployment, 401k balances are going down, people are scared, and everybody's running around yelling, somebody needs to do something. Well, politicians, that's the one thing they're not ever going to be accused of doing, which is sitting on their ass doing nothing. They came out and said, well, we're gonna fix this. So the Federal Reserve and the other central banks, Bank of Japan, ECB, lowered rates. So what this did was it allowed a lot of companies that probably should have went out of business. Specific examples were high profile was General Motors and Chrysler. They both should have went out of business. They should have went bankrupt. That doesn't mean that they go away. What it means is the debt goes away, they get restructured, they get downsized, and whatever assets are still economical would come out of bankruptcy, emerge, and move on. The wealth, the plant and equipment, the resources, the technical knowledge doesn't go away. It's just over indebted. The debt goes away. But of course, we weren't going to do that because we had a Democratic legislature and a Democratic president, and we had a lot of union members at risk. So we basically kept these companies afloat, and they were able to borrow money. Matter of fact, the government bought a lot of the bonds themselves. Pension fund bought a bunch. It was all guaranteed by the full faith and credit of the United States government, which means you, the schlub taxpayer out in Ames, Iowa. So a decade of these zero interest rates has enabled many zombie companies that should have went bankrupt to remain alive. So when you have debt, and you have a massive amount of debt, and your interest rate payments are very low, well, if your business is even, just barely making it, you can still make your interest payments and stay alive. That's what I refer to as a zombie company. So what's even worse is many uneconomic companies, businesses, and industries came into being that should not have came into being because of free money. When you're making a economic calculation in a business, or you're going to try to start a business, one of the considerations you take into effect is how much debt am I going to finance this business with debt? Is the bank going to finance it? And if interest rates are real low, the threshold for making these decisions is lowered. So a lot of businesses that are really not economic businesses that shouldn't have came into being have come into being, and that's very bad. So here's where we start seeing the problem. This is a chart that shows going back to 1962, it shows the average amount of debt that corporations have as a percentage of GDP. And as you can see, that since 2008, we've broken new records here. So basically, the amount of corporate debt that we have as a percentage of GDP is now closing in on almost 75% of GDP. So this is all fine and dandy as long as the economy is rolling along and people can service their debts. The problem begins to happen or manifest itself when the economy turns down, business turns down, cash flows become constricted, and the ability to service debt then becomes in jeopardy. And we're going to get to that right now. So speaking back to the zombie companies, what we've seen now is a large amount of companies now that don't have very high credit ratings. Triple B is a rating that is one level above what is called junk bonds. And we've all heard about the Michael Milken story. He was the junk bond king. This is how a lot of telecoms, this is how a lot of internet companies got financed with junk bonds. They end up going bankrupt. They get restructured, blah, 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 blah. Problem is, though, is that currently economic conditions for a lot of these zombie companies are not very good. So they are right on the threshold of being declared junk debt, junk bonds by the rating agencies. So what we've seen is a lot of companies that are triple B, about half the debt that's been issued in the U.S. by corporations is rated triple B. And this is kind of going back, if you watch the movie The Big Short, when they were talking about mortgage debt, it was kind of the same thing. You had a lot of low quality borrowers, people that probably shouldn't have been given loans, and this was becoming a large portion of the overall debt pie. And when the economy turned down and these people weren't able to make their mortgage payments, a lot of assets were out there to be sold, not a lot of buyers, prices go down, feedback loop ensues, and you have a great financial crisis. Now, I'm not suggesting that the same level of debt is present in these corporations, but a lot of it that is out there is right on the threshold of being declared junk. And we are now 10 years into an economic expansion, and we are going to have a recession at some point. What is going to happen with all these companies that are on the threshold of being junk bond debt holders or issuers, and we're getting ready to go possibly into a recession? So we've talked about the fact that credit quality is not high among U.S. corporations. That's on the threshold. Half the debt is on the threshold of being junk debt. And now here we have a chart that shows us where I think the real problem is. Over the next 3 years, we've got approximately over almost $2 trillion in debt that needs to be refinanced. So this is the problem, right? If you are a corporation and you are triple B rated, that means you're on the threshold of being declared junk, your debt. And now you're going into a situation where over the next 3 years you have to refinance your debt, outstanding debt. You have to do this with lower quality credit rating and higher interest rates. Remember, interest rates have been going up for the last couple of years as the Fed has been raising rates. So the amount of interest you're going to have to pay is going to be higher than when you first issued your debt. This could be a problem. You may not be able to roll your debt because some people might say, wait a minute, you can barely pay your interest payments now at the lowered interest rate you had. You now have to roll, $10 billion in debt, and you have to pay twice as much or 50% more or twice as much in interest, and your business simply cannot generate enough cash flow. That's where the problem is coming. And we're not even in a recession yet. So here's how I see the sequence of events going down in this, what I think is going to be the trigger for the next financial crisis in the U.S. So as corporate debt begins to mature, companies must refinance their debt. They have to. They'll be financing into a higher interest rate environment and potentially tighter lending environment. There's no more free money. If you're going to come and borrow money and your credit, the credit rating agencies have declared you one level above junk, and you need to demonstrate to the bank or to bondholders that you can make your interest payments, you may not be able to float that debt. That becomes a problem. Now, being 10 years into into an expansion and a rising rate environment means a slowing economy and possible recession in the next year or two or three. So now we're going to have $1.6 trillion in corporate debt having to be refinanced at higher rates with declining credit quality conditions, tightened lending standards, and less ability to generate cash flow. And that's the next bullet point. Possible recession crimps cash flows to service debt, and risk of credit agency downgrade leads to higher financing costs. So now you have to pay more in interest to service your debt while your cash flows are being constricted by the recession. So here's the little logical thought train, if you will. Deteriorating economy leads to lower cash flows, which leads to an inability to service debt, which leads to default, which leads to more tightening credit conditions as perceptions change, obviously, in the markets and at the rating agencies. They will start tightening their standards. That's more stress on the corporate finances, because people that even can service their debt will have even more onerous conditions put on them, because, like I said, the perceptions in the market will have changed as we start seeing defaults. And then you just rinse and repeat. It just gets into a feedback loop and keeps going. So here's where the opportunity comes to. The corporate bond market in the U.S. is a $5.8 trillion market. We've seen decreased credit quality. Triple B is now 48% of overall debt. Triple B is one step above junk debt. If a triple B bond gets downgraded to junk, it is no longer considered investment grade. This is very important. There are various entities that invest in corporate bonds because they are perceived to be safe. You have ETFs, you have insurance companies, pension funds, banks, endowments, and they all have investment charters. And in most of these entities, consider bonds to be safe investments. So they are normally precluded, that means not allowed, to invest in debt that has been downgraded to junk status. They have to divest themselves of this. The problem is that the bond market is not like the stock market. Everybody watching this video understands how you can trade stocks on your phone. You can whip out your phone on Monday morning. If you want to buy 100 shares of Amazon, you could just punch a couple buttons, swipe, and it's done. That's not how the bond market works. The bond market's very opaque, it's very illiquid, and in many cases, I've bought individual bonds, I've bought and sold them. You have to call a broker on a desk, on a bond desk, and sometimes you have to have 3 or 4 accounts at different brokerages, because not everybody will be able to get the bonds or have access to the bonds that you want to buy. So you have to call around and say, look, I want to buy 10 bonds of XYZ and at 98.84. And then he's going to say, okay, let me call around. Then you might get a call back in 3 or 4 hours, or you might never call you back, and you have to call him back. It's not liquid. So he has to call another human on another desk and try to say, well, I got this guy that wants to buy 10 bonds at 98. Can you do this trade? Yeah, I can do it, but I can only give you 5. I mean, that's really how it works. It's not very efficient. It's not very easy to do. So what would happen if you had all of these entities now? We get into a credit crisis environment where bonds are being downgraded. There's defaults happening. People are getting scared. Perceptions have changed to negative from positive. And then all these endowments, pension funds, insurance companies are trying to sell the same bonds into an illiquid market. Well, the price is going to drop massively. And this is what has happened before. This is what happened in 2008. This is what happened in 2000. This is what happens in every recession, okay? This happens in every credit crisis. The prices drop. I mean, eventually there'll be a buyer if prices drop enough. So prices go down big time, we have a crisis. The pendulum swings to extreme pessimism. Even the good bonds get thrown out with the bad, with the bad ones. So at some point, hedge funds, vulture funds, and other astute investors will step in and start buying up the bargains. During the last crisis, funds were picking up bonds with yields of 20 to 30% plus. Now that doesn't mean the bonds were issued at 20 or 30%. It means that the prices of the bonds had dropped so far because they were so illiquid and the perception in the economy was so negative, negativity was out there so much that you could buy a bond of a decent company that was easily able to make its payments on the interest rate, the coupon rate on the bond, but the price of the bond had so dropped that the effective yield was 20 or 30%. So that's an extreme once-in-a-generation type opportunity where you're buying a bond that's paying, it's so low that the interest rate you're being paid is effectively 30%. And what eventually happens is things bottom, the end of the world doesn't come, and things begin to recover. Money starts flowing back into this. People start buying these bonds. The wheat gets sorted from the chaff, the good from the bad, the clean from the dirty, and then the money starts flowing into those. Prices begin to recover. the yields go down, but if you've bought your bonds at the bottom, maximum pessimism, you're still going to be getting your effective yield of 20 or 30%, even as your bond price is recovering as liquidity returns to the market. Worst case scenario, the Fed comes in. This is what I expect to happen because I expect this crisis to be very bad. The Fed will come in and just start buying corporate bonds. And people might say, well, how can you say that? Well, the ECB and Bank of Japan have already done it. So, I mean, the rules go out the window when there's a crisis. We've seen that before. And I suspect that once that happens, then that will really encourage a lot of speculators and good money investors to start coming back into the market. That's what the thought process will be. I will be using ETFs on the downside and upside. I probably won't be trading individual bonds. Now, I don't think the time is right now for this. I don't think we're in a crisis right now, but you can start to see the cracks are developing in the ice. We're starting to see if things continue, and the economy continues to weaken, which it looks like it might be topping. We're not near a recession yet. I don't forecast a recession for this year, but I do think that things are going to start deteriorating as we go through the year. And I do think that we're looking at a possible recession next year, 2020. Yeah, but some of these things will begin to manifest, and I think it's something that people need to keep an eye out for because everybody's wondering what's the next crisis, what's the thing that's going to cause the next downside move in the markets. So I can guarantee you when credit quality starts to deteriorate in corporations that stocks will be leading the way down. So it's something to keep an eye on. I think it's not something to be afraid of. It's something to understand. And I think this is a good primer. I'll be talking about it more as things begin to manifest. But I wanted to get this out there. It's kind of hard to understand if you don't really understand how bonds work. But like I said, I'm happy to discuss it more. Put comments in the comment section, whatever. We got a lot of smart people out there. We'll get it figured out for you. But I think this is going to represent a once-in-a-generational opportunity once this thing gets going and gets bottoms out. So that's it for this week, guys. We'll talk to you next week. Thanks a lot.